Let's do a quick system check. So audible, visible. Steve says yes, yes, and yes. Oh, that's great. Good morning, Bob. Morning, Steve. Your question, has anyone had a good week? Yeah, I think week to week, I had a good week. Not that it matters a lot in the large scheme of things, but my account was up if I compare for last 5 days. I mean, think of sim shows you day D minus 5 Netlick and yesterday. So yeah, I had a good week. Overall, yeah, markets are still tough, but that's okay. Good afternoon, everyone from Michigan. Hey, Ramesh, good to see you back. I think we missed you for a few sessions. Bob says I didn't trade this week, so mine was good. No, I was active. I mean, again, most of mine were try to reduce delta, continuously reduce delta. So most of the profitable trades are hedging trades. I think this year, delta reduction trades. But yeah, from long stock perspective, I think I saw some strength on the Chinese stocks in my portfolio. They have done well. But otherwise, overall, I think week to week basis, many of the stocks were still down, but overall portfolio did better. Samuel says, so I just saw comprehensive CNET doc on electric vans. On the EV side, Tesla raised the prices of its cars. So even the luxury cars are not immune to inflationary pressures. So they raised the prices. And I guess even there was a note from Ford or GM, one of those legacy car makers who are moving into EV. There was a note saying they're not going to be profitable. Not that I expected them to be profitable on EV side, but just setting investors' expectations is what the management was doing. But yeah, it's EV is anyway a long play, and personally, I think Tesla is still. Where is Tesla right now? Let's look at Tesla. So let me just bring up Tesla since we talked about EV. So this is Tesla is 650. Let's look at 3-year. So as you can see, it is still, up almost. So we had our pandemic in around here. So it's still, up 200% since pandemic. And I don't know why it's still so high. So I'll be patient on Tesla. As you know, my EV plays are different. A couple of Chinese EV plays and a couple of US EV plays. And Tesla is not one of them just yet. Ramesh is saying collecting premium on covered calls and taking loss on puts. Yeah, if you have puts, those aren't doing good. So I think this week, I've started getting into naked puts on a small value takers, right? Anything above $100, I don't have any naked puts. So that's been doing good. At maximum, if I have, is a put spread, which is actually a part of Iron Condor, right? But I think maybe on financials, ETF, I opened a strangle, means I have a naked put. So I've been very focused on my deltas. Then I want my overall portfolio deltas to be within a certain range. And if they go out of that range, I'll be quick to reduce deltas in the portfolio. So So I was looking at, in terms of how the options performance has been. I would say that is still keeping the lights on. The long stock positions, as you know, haven't been doing great. Many of the stocks are down 50%, 60%. But overall, option side of the house is still keeping the lights on, still keeping us afloat, and continue to stay engaged in the market. Even considering any of the puts that I've got assigned maybe earlier part of this year, option side is still better. But now is the a time when whatever we've been learning about options around risk management, using options to reduce the risk in portfolio, using options to increase the cash flows. Now those things are working out. I had to wait, 5-6 years before the market actually becomes more favorable with some decent volatility and good enough premium on many tickers. I mean, this has been the perfect environment for options 2022, right? On an average, so if I pull up the average year, VIX has been around 25, right? Which is almost 50% higher than the VIX long-term average. So that's great from a premium selling perspective, right? And that's why the premiums on the options are rich and has been working out great. Steve said VIX above 30, perfect to sell premium. Long term, Steve, VIX on an average stays between, I would say, around 15 to 20. Right? It's only in 2020, after 2020, we have seen VIX going above 20 on an average and staying over there. So we go back and let's say if I can get this is 3 year 1 day. Let's change the time frame. But I have traded when the VIX was like 12. I've traded when VIX was single digit. So I know what you're saying. So I'm pretty happy to see VIX at around 25. I won't complain. 30, yeah, will be great. But I don't think that we will ever, on a long-term average, we could get to a VIX where it stays, around 30 from a long-term perspective. So let's increase it to 10 years. Right. 16 over here is 13, 15. So, ignoring the momentarily spikes all the way from last 10 years, right? It's been around 15, 15, 16, that's kind of an average. Now March 2020 was a different, it spiked up to 85. And since then, it hasn't really gone down. So these 2 years have been great from a options premium selling perspective. These opportunities may not last for very long, right? So I'm pretty happy. It was very difficult to stay invested and do options around 2016, 2015, 16, 17. But now last years have been great. All right. Any further comments on overall market before we jump into today's session? So we will talk about, as always, we'll look at some of the macro stuff. Today, I also want to cover a state of the cloud report from Bessemer Venture Partners. I haven't read through, so maybe we'll do a reading together. And a couple of earnings on some of the stocks. So that will be an overall agenda for today, unless there are some questions and we want to talk about something else. So let me know. I mean, the premiums are so rich on these options, but also be aware that if Fed become little dovish, or if the markets improve a little bit, we see some improvement on the supply chain or inflationary pressures coming down, we may see a a rip your face kind of a rally. So could happen. When will it happen? No one knows. Has the market bottomed? Every time, in a week, multiple times I get a feeling, oh, the market has bottomed. Then you see, okay, it goes down another 5%. So this week, S&P was down another more than 5%, right? 5.5%, something around that. So it's no one knows where the bottom is. So I don't want to even guess that. And that is why I'll stay invested, continue to sell premium, reduce the cost basis, and stay engaged. AWS is very sticky. Once a company moves to AWS, it is hooked. I think there's at least on the market, I'm seeing companies moving towards multiple options, not just AWS, because AWS becomes pretty expensive if you don't know how really to manage your workloads and when to spin up clusters and the services, when to tone it down. So there are companies which are working specifically on creating systems which will allow you to manage your AWS costs. Otherwise, the cost could go pretty much out of whack. So but it is sticky. I mean, not just AWS, moving to cloud is sticky. There are mandates for, especially given this whole, if you think recession is coming, cost cutting will continue to happen. If cost cutting continues to happen, the mandate will for the CIOs will be to reduce your IT spend, which means they have to move towards more and more towards cloud. So that's definitely, I mean, I'm seeing in my professional life, we are working with many clients who have got deadlines of by when they want to move all their workloads onto cloud, and not just one. We have clients who had earlier decided to implement on-prem on their data centers, now realizing that the cost of their internal cost of implementing is really high. They are back to discussion, with our with us and with our sales team on, okay, let's talk about the cloud offering. So irrespective of whatever we are seeing in the market, especially on the Googles and Amazons of the world, I think Amazon is not, again, after the initial pop of for the split, it has come back down. This was a pop for the split happened, back to normal, right? So irrespective of whatever is happening, these stocks, Amazon is down 30% from their 52-week high. Google, almost same case. From a usage perspective, this continues to increase. The spend on these cloud players will continue to increase. So, and this is not, not just AWS. It's not winner takes all. There are, Lena, you're right. There are other multiple cloud providers. They will bring competition to the market share. So they are already competing. The AWS overall market share is reducing, and the competition, Azure, 5 years ago, Azure was nowhere. They were still building their solution. Now Azure is a force to reckon with in terms of the overall market share, and the way they are growing is also crazy. Right? Another service provider which is not mentioned here, which we talked about in 2020, was Oracle. They pivoted, they put in a lot of engineering bandwidth behind building their cloud solution, and I know it because some of my ex-colleagues went there and they were asking me, hey, why don't you join us? We're building our Oracle cloud infrastructure, right? I wasn't really interested in Oracle as a big company, but I knew that they are working to compete with, they were late to the game, but they really had great people and to build a cloud infrastructure. And I mean, that Oracle investment in the last 2 years have worked great. While all the other stocks are down, Oracle has almost doubled. So they had got some marquee customers as well, right? 8x8. Zoom was one of Oracle's biggest win. Another one is TikTok, which was a marriage forced by Trump administration. So Oracle is again, heating up. They are gaining market share from other parties. So yeah, the spend on cloud will continue to increase. Right. TikTok moved all US data to Oracle. They were moving it for last 2 years. I think now they have completed the movement. Not last 2 years. Whenever this marriage was forced by Trump administration, the whole idea was US government does not want US users' data to be sitting in by Chinese cloud providers. So they wanted TikTok or the parent company of TikTok, ByteDance, to marry with some US cloud provider and keep US users' data in there. Microsoft was, I think, if I recall correctly, I think Microsoft, even Walmart with some cloud provider was also in the race of marrying with TikTok. Eventually, it was Oracle. They decided to partner with Oracle and started moving their data, US users' data. And yeah, there was a report in Wall Street that they have completed the migration. Now, all the data of US users in TikTok is being hosted and managed by Oracle. That does not, there was another report. I have not gone through, I just read the headline on Wall Street Journal saying still the TikTok employees in China were able to gain access to US users' data on Oracle data centers. Now, how far it is true, I don't know. It looks like in some of the internal meetings and the recording of those meetings, audio recordings of the meetings, some investigative, journal reporters might have heard saying some of the technical teams might have access. If you're more interested, just search for Wall Street Journal news. Basically, I think both the news came maybe on the same day or one after another. Is TikTok still has access to TikTok Chinese employees still have access to some of the US data, but I think this battle will continue. Especially on the cloud side, we are seeing the companies are becoming very finicky about where you store their data. Of course, China and the US have been having those tensions, but now even on the EU side, there are questions that are being asked of us from our, Europe or EU customers on where we're storing data, depending on, to have now in the RFPs, they will definitely ask for how do you ensure the whole GDPR adherence. Are you going to take EU user data outside of EU and all that stuff? So, yeah. Sam says in 2020, Oracle was third largest software company in the world by revenue and market cap. Oh, that's, I didn't know that. I mean, frankly, I never focused on Oracle until I started feeling some, getting some Oracle, my ex-colleagues in Oracle started reaching out to me around for joining Oracle, especially on their cloud infrastructure team. So looking at software, let's say technology, let's look at market cap. Oops. And if we just look at software infrastructure, let's look at only the software infrastructure, then we'll see. Okay, Microsoft, Oracle, Adobe, Apple is more goes around the consumer side. VMware, Palo Alto, Synopsys, Lena. They bought Solaris years ago. Oh, that came through their acquisition of Sun Microsystems. Started to compete with Red Hat. Yeah, I think there's Sun Microsystems. Solaris used to be a very hot way back in 2000s, almost 22 years ago. Really didn't work out. I mean, the Linux took over the whole market of data center servers. So that acquisition didn't really pan out. Of course, they got licenses for Java and all that. So I think from in Oracle, lawyers are what do you say? They are very they are pretty strong. So from a patent perspective, Oracle got a lot, but from an adoption, Solaris operating system really didn't work out much. Of course, since we're talking about Oracle, they also completed the acquisition of another company, Cerner, Sentient, the company in healthcare. Forgot the name. Cerner. Yeah, we talked about it when they did. I think so. This was one of the biggest acquisition by Oracle to get foray into healthcare, specifically into the healthcare segment. So yeah, it's an interesting company. Oracle. Let's see where look at their journey. I think we started talking about it when it was around 40s, and in 2020, yeah, it was around there 40, 50s. So of course it has come down based on the the valuation of all of other companies, but still I think I am still bullish on Oracle. Will continue to hold it in my portfolio. Sam says Oracle is boring. Sometimes, not sometimes. I think most of the times the best investments are actually very boring. The exciting stocks are good for sugar rush. I don't think if they are the best for our portfolio or for our pockets. So, yeah, just that investment is the most boring investment is Berkshire Hathaway, right? Doesn't do much, but when it comes to giving us a return, it's a great returns. So if on a sugar rush, yeah, we all need that. We all need adrenaline. So yeah, could invest some into some of those meme stocks, but boring might indicate that it's a mature industry, continue growing, not creating too much of a volatility from an investment perspective. That might turn out to be the best one. Financial advice. I mean, you see in terms of how the companies are performing, and then we take positions accordingly. All right, so today we're going to talk about our main topic will be SaaS Dad. We'll look at the state of a cloud report by Bessemer Venture Partners, a pretty respectable early stage VC company in the Bay Area. So we'll go through that. Then, of course, we'll look at some macro, some companies, and a couple of earnings as well. All right. As always, nothing is financial advice or tax advice. Do your own due diligence, guys. Do your own due diligence. Macro side. This is what the market is expecting, that how the economy will land. It probably won't be a soft landing as what Fed has been trying to do. I think now even Fed acknowledges that the probability of hard landing is increasing day by day because inflation just seems out of control. Now, whatever you may actions Fed is taking, inflation is still it's getting close to 9%, right? And we'll see, what happens, because there is only one tool which Fed has in their arsenal, which is to increase and control the interest rates. But that is it going to help in the real causes, which is for inflation directly? No. The big one of the big cause of inflation is the supply issues, broken supply chains, and number two is a war, which is causing inflation in the energy and the commodity side. is raising interest rate going to help all of them? Any of these causes? Absolutely no. What it would do is maybe do a demand destruction, right? So either you fix the supply, when the supply increases, demand stays the same, prices will come down, basic 101 eco, or you reduce the demand. Unfortunately, the tools that Fed has is demand reduction, or at an extreme side, call it as a demand destruction tools. And that is what's happening. They continue to increase the interest rates, which will reduce the demand because everything, loans become more expensive. And but if it becomes too much, it could actually lead into push us into recession. And that is what market is fearing right now. So the Fed report, I think the New York Fed models says that the chances of hard landing are about 80%, right? While probability of the soft landing is just 10%. So that is why spooking the markets, but I don't think markets has decided to figure out where it wants to go. So I don't expect the recession to be very near term. Former New York Fed leader William Dudley said, I think it's mostly 23, 24 story in terms of hard landing. So pain, main, again, if we have to believe New York Fed, or if we have to believe any Fed officials from their perspective, the pain is, we have not reached the point of maximum pain yet. Might see more pain in 2023, next year. But take it with a pinch of salt. Fed has been wrong for 18 months now in terms of inflation, transitory inflation. So what do they know, right? Ignore the fact that they got 400 PhDs working for Fed, but no one can predict the future. Doesn't matter, whether you're a PhD in economy, PhD in statisticians, or you're a macroeconomic guru. Markets are very difficult to predict. Something that caught my eye is this is a situation of, what's happening in the markets today. Right? A consumer is, an investor is calling Acme Financial. How can I help you? Yeah, I'm calling because most of the stocks you had me buy are much lower. So you're supposed to be my broker, and I made you broker. Yeah, it's it's fun. Why they're called broker? Yeah. All right. Now, expectations of hard landing is pushing markets to close in red. Fed raised the interest rate by 75 basis points. That was the highlight of the week. FOMC meeting Wednesday and Thursday. That's the most aggressive hike since 1994. That means 1994, almost 28 years. S&P is down now 24% from its January peak, confirmed in confirmed bear market territory till date. Prior to this week, it was only Nasdaq which was in bear, but now even S&P is also in official bear market, which the definition is down more than 20% from your all-time high. Every member of S&P 500 was in negative territory at some point of a time in this week. I don't know where. I think that probably was Thursday. All 500 stocks were down. That's something that hasn't happened since 1996. So it's a bloodbath. It's a fire sale. Doesn't matter what kind of company you're holding. Everything is on sale. Not just the stocks, even the so-called inflation hedge, gold on sale, metals on sale, energy, even this week energy was also on sale. Only bonds, let's talk about bonds. Bonds haven't been working out. The whole, I think maybe next week we can talk about, there was a big article I read about 60-40, the traditional, a portfolio the traditional wisdom on how one should construct the portfolio, including stocks and bonds, because when stocks go down, bonds will go up. They have an inverse correlation. Hasn't been working. Stocks, no secret, stocks have been just beaten down. And if you look at the bonds, they haven't been doing great either. TLT, 30-year bond, starting 2022, is now from 148 to 108. It's down 30%. I mean, it is as down as what the NASDAQ is, right? Or S&P is. So bonds really haven't worked out. So whether you had 60% in your stocks and 40% in bonds, the portfolio is still deep in red. So only thing that I think more and more we go through these cycles, we realize that the only way to do a protection is to focus on deltas and reduce that. I think the correlation works out only when the times are not dire. When the times are okay, when we are in a normal markets, that's when these bonds and the stocks are inversely correlated. But when there is a fear in the market, everything sells off. So if you want to really protect the portfolio, you'll have to look at other instruments or other strategies for portfolio protection. Combination of bonds and the stocks didn't work out in 2022. It didn't work in 2020. It didn't work in 2018. It didn't work earlier also. So I think this is the concern I have. When you need it most, it doesn't work. And when you don't need it to work, at that time, it becomes inversely correlated, which really doesn't help. SP says, what a recession. Yes. So that's the official definition of recession is GDP is negative. The growth in GDP means a GDP contraction for 2 successive quarters is recession. So we had a recession in so-called technically called recession in COVID, when for 2 quarters, because everything was shut down, the GDP contracted, but then we came back up. So how long could the economy stay in recession? That also depends on monetary policy. This time it may be a little longer, right? Because if Fed, if interest rates continues to go high, companies start to feel the pinch and they increase their cost. They will not be willing to increase their production. So, but we'll see. I don't have any crystal ball, neither does anyone else. So who knows? Steve says, generally sell all individual stocks and buy SPY, reduces deltas the most. It might reduce the volatility, not sure about the deltas. It depends on what kind of stocks you hold. The volatility, I agree. Deltas, you really have to look at what's your beta weighted deltas, right? So I always look at my overall portfolio deltas, which is weighted to what kind of stocks I hold in my portfolio. So if I have all the large cap stocks, then I will look at equivalent of SPY deltas and use SPY to reduce the deltas. So for me personally, I use these indices SPY, QQQ, IWM just for hedging. In options portfolio, okay, let me just say QQQ because I hold tech stocks. All you can get is all these calls which I hold, 24th June, 1st July. And these are the indices are the only ones wherein I have some weekly calls just from a delta reduction perspective, right? Same is the case with SPY, reducing deltas by selling calls. Third one is IWM. These are just, I don't hold any positions, but I just have for reducing overall deltas in the portfolio. So these are my vehicles for delta reduction in portfolio. And when I look at, oh, this delta market has fallen down, and now I see my overall deltas have increased. Yeah, I'll go and sell, 30 delta call or 20 deltas, 2 contracts of 20 deltas, depending on, what my outlook is in near term is. But these are the ones, these are the positions which are the most beneficial for this year. My top 3 performing tickers are QQQ, IWM, and the third, I think fourth one is SPY, all delta reductions. Yeah, I mean, these provide some cushion against some of the stocks that have been decimated. That's okay. All right. So what happened this week? Mr. Market doesn't know what they want to do, right? Because Wednesday, when the Fed came and told, we're going to do 75 basis points, right? So on Monday, everything was red after the inflation came in, and the market started discussing, no, Fed should actually do 75 basis points. 50 is not good enough. It's not going to control inflation. Market priced in 75 basis points hike already. So markets were in red on Monday. I don't know about Tuesday. And then Fed came with an announcement around saying we're gonna be 75 basis points. Markets just became green because that was already priced in. Fed said what the market was expecting, and markets ripped higher, right? Next day, market changed its mood, thought, oh, even though 75 basis points, but it may not be enough. I don't know. I mean, you asked for it, you got that. But market doesn't seem to make up its mind, and it went into red. We lost all the gains that we had on Wednesday, became red on Thursday. And then on Friday, I don't know what happened on Friday. Well, Thursday, Friday been pretty busy days at work, but Friday after during lunch, notice markets are all green. I think in the early morning I did probably sell 1 or 2 calls, but it's all market closed higher on Friday. I think overall it is still down for the week, but these are right day to day. If you are making decisions on what's happening on that day, we have no idea. We'll be running like headless chickens because that's where the market is running around like headless chicken. So keep a long-term objective and short-term steps to achieve those objectives. So what happened in a day should not change your long-term objective unless something has materially changed in the business. Steve says, and okay, take everything SPY and then sell SPY covered call to reduce the delta further. I like that. That could be one of the options, is to just hold SPY or just hold indices and sell covered call on those indices. Right? But someone mentioned, right? Sam mentioned it's boring. It does become boring, and there is, you basically give up any chance of generating alpha, which I would still say 90% of the investors should do just that, is focus on indices, not a financial advice, but the numbers say themselves, right? Most of the fund managers, they can't beat SPY. So if you're not active into, sorry, or not interested in spending time in analyzing the companies, and you don't really care whether you got a multi-bagger or not, as long as you're making some decent returns, what market is giving, that's a great strategy. Is just hold SPY and generates consistent income by selling covered calls. Ramesh says index also has a tax advantage. If you are only dealing in SPY indices, I mean index and not the ETF, which I don't think every not possible for every retail investor, because one index of SPX will cost you $3,675. But if you are dealing in an ETF, which is SPY, I don't think there is tax advantage. Correct me if I'm wrong. I think if you are dealing in an index, you get the 60/40 section 1256. Again, I'm not a CPA, but there is a contract 1256 or section 1256, which any gains in the indexes, if you're getting gains in indexes like SPX, like RUT, which is a small and medium business. You got NDX. All the gains in these indexes are taxed at 60/40. Now I forgot which one is it, 60 long term or 40 long term. In this is tax treatment. So that index tax. Okay, let's say 1256. Let me just 60 is a long term, 60/40. So which is great, right? If you're dealing in, but if you have enough capital to buy these, high priced ones. So if you're dealing with the QQQ, which is an ETF based on NDX, and you sell it, get a gain in less than a year, it will be taxed at short-term gain. But if you're get a gain on NDX in less than a year, 60% will be long-term, 40% will be short-term. So that's the tax advantage. Ramesh, I hope that is what you meant. I just wanted to clarify. I didn't say anything different. What else is a housing market? Contagion is now spreading towards the housing market as well. We saw one by one the dominoes falling. Housing market was still holding strong so far, not anymore. Last week also, we looked at housing markets and how even the luxury segment is now being impacted. Building permits fell 7%. Housing starts sank 14.4% last week. Job market, not that great either. I mean, it's not that there's a bloodbath right now. Though in some of the smaller tech companies, there is a lot of firing going on. But overall, on the job market perspective, jobless claims $229,000, not too shabby, but it was a little higher than what was expected. By the way, if there is a website which tracks the recent job, the hiring and firings that's going on, mostly in the tech and in the startups. If anyone wants to know, this is the website, layoffs.fyi. And if you have some openings, you also got a list of, which companies fired how many people. And if you want to hire some, some folks from your competitor who is now laying off, this link will be handy. All right, getting back, factory activity, which could indicate, contraction in GDP. So factory activity, we saw some contraction first since the onset of the pandemic, because after the pandemic, things started to open up. We started producing more, factory activity increased, but this time we had a surprise contraction. Same is the case with retail sales. Overall, the sales fell 0.3%, dragged by auto purchases. It is mostly driven from fact that the loans have become more and more expensive. When you're talking of, the mortgage is now what, more than, so at some point of a time, 30-year mortgage was above 6%. Okay, even now it is above 6%. So it's crazy. So that is why people are postponing their home purchases, because their budget has now suddenly gone, got haywire. If you started this year by budgeting, $1,500 for your monthly payment, now you are staring at $2,200 for a monthly payment. So it's not easy, when everything of, if you're in a house, if you're in looking for a house, a start of this year, now the interest rates have shot up so high, you can't afford that house anymore. So either you have to go for a lower one, or you basically wait. Right? Yes, Steve, it affects the new buyer. Refinance industry is kind of almost dead for now, because no one would like to refinance who had already refinanced in last few years, right? So we saw Wells Fargo laying off people in their mortgage department, refinance department. Big companies like Rocket Mortgage, their shares are in the dumps, because again, no one's gonna do the RKT is a second biggest lender. Now, it hit a new all-time low on Friday. So mortgage industry not doing it good at all. The mortgage applications were down the most since 22 years. So it's been tough out there. Unless you're of cash, can get some pretty deep, good discounts on home. I wouldn't say deep discounts. That hasn't happened yet, but some good discounts on homes. We are seeing, homeowners now repricing, and week after week, reducing the taking a haircut on their expectations. But if job market becomes tougher, we see a little more bloodbath on the job markets. It might, may not be long before those who had bought homes in 2020, if they lose the jobs and can't afford to pay for, to mortgages, those houses will start to come onto the market. And then we should see even sharper decline in the housing prices. Treasury, 10-year Treasury note has high as 3.49, but closed above 3% on Friday. So unless energy, worst week, it was almost the worst week for energy in this year. It was down like 17% for this week. After having an incredible run, I think energy is up like 50% year over year. And even for this year, they have had some incredible runs, but now we'll see what ran out of steam or what. So this week was brutal for energy as well. Have been having some great run over all the way through 2020. So this is XLE, which is energy ETF, was $55 and was up like 93 as of last week. So had a pretty good run. Congratulations if you were in energy sectors and held your energy stocks. That's what it pays to be diversified. Energy hasn't been doing that great for past many years, but over last 1 year, that's been the best investment. See a question, any insight on I bonds? So we covered in details about I bonds, which was it 2 weeks ago, 3 weeks ago. So I bonds right now are paying 9.62, but there are some caveats that you should be aware of when investing in I bonds. So hold on, let me just see. Okay, so let me just quickly give a summary on what we talked about on I bonds. Right. This is as of what mid of May. This is paying 9.62%. but you can maximum invest only $10,000 per SSN. So you can invest for yourself. If you have a spouse or a kids, basically individual as one SSN, you can have maximum 10,000. There's a backdoor entry. You can get another 5,000 if you direct your tax refunds to directly invest in I bonds, right? But remember this thing, it's the way they calculate the rate on I bond is your coupon rate, which was 0% plus inflation adjusted rate, which was 4.81%. So inflation goes down, the rate on I bonds will also go down. It gets adjusted twice a year. So whatever the rate right now is valid till October 2022. Other thing you should be aware of is, yeah, we talked about this. You can buy another 5,000. So you can cash it after 1 year, but if you are buying I bonds, you are basically locking your investment for minimum 1 year. You can cash it after 1 year, but you will lose 3 months of interest. If you don't want to lose that 3 months of interest, you have to hold it for minimum 5 years. Okay. You cannot buy through brokerage or IRA. You have to go to the website, Treasury website, to buy it. But when you cash in, the gains are taxable at ordinary income tax and not at a capital gains tax. So depending on your income bracket, you may have to pay higher income tax on I bonds. So you won't lose the principal, but eventually if the inflation cools down, the overall return or the interest rate on the I bonds could be adjusted to a lower price. So think about that and then make your adjustment. You have to lock your capital for minimum 1 year, and you have a maximum amount of 10,000 plus 5,000 through backdoor that you can invest in I bonds. All right, a quick look at the indices. S&P is down 23% for this year. NASDAQ is down 31%. Those are the major ones confirmed in a bear market. I think every other indices is in bear market except Dow Jones. So if you're feeling the pain, you're not alone. Everyone in the investing community is going through the same pain. So don't think that, you are the only one. As long as you're holding good companies, good businesses, I think we have to go through this. And this is not the, while we are into this whole, recession or bear market, it's not easy. It's painful. It's stomach churning. Doesn't matter how many times I've gone through it, but I'm of a firm believer that human ingenuity will continue to win. We will get through this as we have gotten through, many of the other previous bear markets. Best thing is how you can continue to survive, how you can continue to be in the market so that when it turns around, you are there for the gains. M says, how about put on DIA? I generally don't focus much on DIA. Even though it's the most quoted index, but it is not really a representative of our stock market, just 30 companies. And that too, it is based on the stock price, which I don't know why they want to do it. So I don't focus on DIA. But your question, I think the question behind the question is, how do I protect the portfolio? Maybe you're from a portfolio protection perspective, you're looking to buy a put, whether it is DIA, S&P or whatever. I generally don't do put buying, especially when the markets are already red and when the market is already very fearful, right? Could I have considered buying put when the VIX was around 15? Maybe that was a time when you could have considered, right? I probably haven't done even on that time also, because long-term put buying doesn't work. So But at this time, if you're buying put, it is pretty expensive, right? The fear is already, I mean, it's like you're trying to buy an insurance now when the flood is, mile away from you. Where is DIA, right? So let's look at DIA. It's almost $300. Looking for next 30 days. It is $6 is an at the money put, right? Which means around 300 means around 2%. So 2% you'll have to pay if you want to protect your investment right now for next 30 days. That's a pretty expensive cost. It means in the next 30 days, if it doesn't work out, you lost 2%. Would you do it for the next 30 days? Afterwards, another 2%. I mean, if we just extrapolate it, it becomes 24% annual cost to protect your portfolio of Dow Jones Index. Dow Jones Index doesn't even return 24% in a year on an average. So from my perspective, I have a hard time in trying to buy a put. What you could do is maybe look at a put spread if you want to buy, or do a collar by selling a call spread and maybe sponsoring, using that money to buy the put to reduce your cost of buying put. Right? Otherwise, it is too expensive. It's already, market is already fearful. This could have been a good discussion, and I wouldn't have felt as bad. Maybe if we would have talked about this when the VIX was around 15, then at that point of a time, we wouldn't be paying 2% to protect the portfolio for next 30 days. Right? The cost of protection would have been less. So use other strategies. So I use other stuff is if, selling calls against it, or, buying or doing a collar in which sell a call and buy a put. Right? So for example, if you want to do this, if you want to buy a put here, 295, say if your whole of your portfolio is Dow Jones. Again, I'm just throwing away 3. Right, and 2. So this actually don't pay anything out of pocket, but if the market goes higher, you will lose $2,500 on this one contract option trade. But depending on how big is your portfolio, this might work out for you because, hey, your long portfolio will do great, right? So you might lose on this option side, but on the long portfolio side, you will do great. But if it goes below, this option trade will work out and you don't pay much upfront. So there are different strategies you can use by using options. Straight away buying put is expensive, and the market has to really react pretty quickly to it. Buy the bears, SQQQ, SOQS, but if you buy the bears means you are putting in, it's not capital efficient. I mean, if you have capital on the side in your portfolio to put in, so buying the bears will need more capital. And be careful if you're looking for a leveraged ones. Again, leverage is not for retail investors. You have to have a very short-term holding period for leverage. Pick any good, investing journal. Every time you hear the same thing. If leverage has to work, it has to work pretty quickly for you. But yeah, there are many options, right? As we'll look, into all these options when we looked at portfolio protection strategies, right? Buying put, selling calls, doing collar, doing these ratio spreads, buying into volatility instruments, VIX spreads, SQQQs, there are a lot many ways of trying to protect the portfolio, figure out what works for you. Steve says, I have several stocks that were assigned to me after selling cash secured puts. They've tanked so deeply and far that I'm afraid of selling covered calls. If they are assigned, I've logged in enormous losses. What you could do, Steve, in those cases is instead of selling just the call, sell a call spread and maybe sell it only on a portion of your stock. I mean, I have many of these in which stocks have fallen, and I'm like, if I sell it and have a rip your face off rally, then I'm out much earlier, and wouldn't be able to participate in the growth, right? So instead of selling a call, in that case, maybe I'll sell a call spread, so that if market continues to rip higher, okay, I didn't participate during the width of the spread, but I'm still there to participate afterwards. So that is one. Other way you can look at is excuse me, if you're holding, let's say 200 shares, you sell only one covered call. So you still have another 100 shares, which will continue to go higher and you'll be able to participate in the rally. The fact is we don't know whether the stock will, where the stock will go. Number two is market and the stocks don't have any memory. We as a human beings have memory. I know that I bought that stock at 20, market doesn't know. And market has no memory that the stock was at 20. Today, that stock is at 10. That is the truth, and that's what the market knows. Now, from 10, where it could go, could it go to 15? Sure, 17, 18, yeah. But anchoring our price at 20, because that's what I bought, is one of mindset that we as a retail investors have to learn. So I was guilty of not doing it. Then I started to figure out how can I continue to reduce my cost basis and not be afraid of, what can I do so that I'm not, get out of a stock and not participate in the growth. So I figured out maybe do it only, maybe sell a call spread instead of selling a call. So that's what at least I use. Dave says, oh, just short the share straight and sell ITM puts to get assigned and buy it back as needed. Yes, that's also an option. Many retail investors are a little scared of selling the shares short. So don't talk much about that. Okay, so Ramesh says, yeah, selling 10 delta calls. Buy the bears, sell weekly covered calls. Do you get much premium for them? So if the stock has gone down to say $10, right? $5, there's not much of a premium, but then your risk is overall is not much. Maximum it can go down is to 0. So there's not much risk remaining in the trade as well. But there are still tickers in which, I hold some which are like sub $10, but the premium on those tickers is like 2%, 3% for next 30, 40 days. So but again, if you don't have the volume, then the time you spend on clicking the buttons and placing an order may not even make sense. But I do have some of the volume on that. And I'm like, okay, if it takes me 2 minutes to do this trade, from a dollar value perspective, that may not be the biggest return, but it's you reduce your another cost basis by 2% in next 30 days. Oh yeah, I will take it any point of a time. Right? So I was looking at some of those worst hit stocks. Right now we are we are done with 5 months. Right? Just based on the option premium, I've taken like 5, 10, 15% recovery just in the premiums, and I still hold all the stocks. Overall, I might be down 30% because the stock has fallen 60%, but getting a premium still has given some cushion. Right? Overall, in this stock portfolio, 25%. If let's say the stocks were where they were at the start of a year, I would have been up 30% just on option premium. But I'm overall down because the long stock portfolio is down, but the option premium has given us much better cushion to me. So yeah, there are ways to do it, and you know, you may not feel the benefit of it by doing it once or twice. Gotta do it continuously, and then you realize some of the stocks you own free and clear. Like I have some of those in my portfolio because I've been selling premium for 3 years. I've sold premium on them. Now I own it at 0 cost basis. So and that's a great feeling. Lena, those 3x ETF, very careful with the DK. Absolutely, leveraged ETFs or any leveraged instruments, right? You have to be very good from a timing perspective. Dave says, I buy the shares, sell 70-80 delta calls for protection. Yes, anywhere for point. Okay, a lot of comments. Best strategy now is park 90% cash on the sideline. Just do one trade per week. 90% of the cash, the return you're getting is negative 9%, which so far probably would have been the best strategy. I don't know going forward how great it would be. So very difficult to time the market. I would still say always keep some dry powder on the side so that you are not forced to get out of the stocks that you don't want to get out, right? So I still have healthy cash position. I think we discussed the pizza last week. Still, there is the cash is one of the biggest slice in the pizza, and you know, this year I've been deploying cash, so I don't have to worry about, you know, margin calls and sell the stocks. Someone, you know, broker taking decision on behalf of me and selling my stocks. Having dry powder always helps. Would I move 90% into cash? Probably. I am not of that, you know, I personally won't do it for my stocks because I don't know when the market could turn around and you know, move back into positive. So I would rather, I personally will stay invested and reduce my exposure or my risk by using options. Dave is in all Tesla club, all it trade Tesla. Tesla, you can either love Tesla or hate Tesla. You cannot ignore Tesla. Eugene says there is no silver bullet. Yeah, don't take advice from any random stranger, or don't take even advice from anyone in here, right? Don't take even advice from me. All I'm saying is what things would have worked out for me. Things may or may not work out for you, because any investment is more personal than more financial. At least that's what I've realized. Was it last week we talked about one stock? Two people are in the stock for exactly opposite reasons. I think it was last week. We talked about Palantir, right? I'm in Palantir for reason A, and the other person was in Palantir for the reason which was opposite of A, right? So because it is our personal belief, our personal opinion on what we are comfortable with. So it is very personal. Don't take any advice. Ignore what I say that, you know, if on option premium, it would have been 25%, because I know how to manage my risk on selling options. Unless you figure out how to manage your risk, it may not, you know, it could be the worst strategy, right? And go back to buying options, but I know that long term doesn't work out. So I don't buy options. But if you don't know how to manage risk, then selling becomes a problem. You know, many hedge funds have gone belly up because they didn't know how to manage the risk, got margin calls, and you know, could hold their portfolio. I thankfully so far no margin calls in my years of selling options. I don't go too big on any risk. So it's very personal, guys, very personal. S&P energy was the worst performing, and S&P is down 5.8%, weekly biggest drawdowns in 2020, down 10 weeks out of 11. Last week, last time it happened was when Nixon was president. So could these be the times when Warren Buffett said that buy when there is a blood on the streets? Maybe, may not be. Could markets go down another 10, 15%? If you really look at the top tech companies and the PE at which they are trading, they are still trading, 18, 20, which is higher than the on an average PE. Could they correct? Who knows? No one has a crystal ball. I read a lot about different opinions on the market has bottomed out, and also how there are equally convincing data points on why the market has not bottomed out. But eventually, for me, I have to make a decision on what will work out for me. Do I need this money for next 2 years while the market go through these, doldrums? If yes, my decision would be different. If no, it's going to be entirely different. So your situation could be different. So you have to decide for yourself. Again, I want to be very clear. This is where, people come and just start blaming either Wall Street or blame Jim Cramer or Cathie Wood, or I don't know, some of you might be blaming me. So it's perfectly fine. But guys, no one is forcing us, or we blame Jerome Powell. No one is forcing us to buy or sell anything. We just have to think for ourselves. Yes. So Dave is a full-time day trader, right? And thanks, Dave, for sharing your background. And be very transparent. So now you know where Dave is coming from. I am not a full-time day trader. I probably look at my screens in the markets. I open my TD Ameritrade generally between 7 to 8. At 8 o'clock, I started having my work meetings, right? And then in between the work, I might do a sneak preview for 10, 15 minutes. And the next time I get an opportunity is around the lunchtime, right? So the way I would do things will be very different. All right, let's jump on to this. I want to talk about the BVP report, and then we can come back to some of the other content. So I think, is there anything which will become outdated for next week? Maybe the crypto I can quickly give. The situation in crypto is not good either, right? There's even a worse things happening on the crypto side. Is the mayhem on the crypto side. Some of the so-called, the lot of what I can call crypto banks, which would give you interest on your crypto assets. Those are going belly up. Celsius was in trouble. They stopped all withdrawals. I'm not gonna get into the details. We spent more than an hour talking about why it happened on our Thursday crypto meeting. So I'll just give you the headlines here. Celsius is in trouble. There's a big venture fund called Three Arrow Capital. It's a Singapore-based venture fund. At some point of a time, they had 10 billion assets under management, have invested in tons of companies in the crypto world. Some of these are here, on the base layer, on the DeFi space, on the companies, as a VC fund, and a fund of a fund. They invested some money into the funds which invested in another crypto assets. So it's a pretty well known, and now they're getting margin calls. Again, risk, right? You got to understand and take care of tail risk. Remember, we talked about the fat tail risk is what most of the people will ignore. Most of the people will ignore about the fat tail risk. Yeah, it could go down 20%, and I think I'll still be okay with 20%. Have you considered the fact that what happens if these companies go bankrupt? Not I'm not gloating here. I've lost some money in this. Okay, because I've been active in crypto, and when these things are down 50, 60, 70%, You're not, I would be lying. I won't be honest if I say, yeah, I'm unscathed, right? But again, did you consider the tail risk and position sized it accordingly? I think that's the biggest question. My position size was okay. I had something I had in Celsius. So right now I can't withdraw it. But was it like 50% of my net worth? No. Was it like 10% of my net worth? No. Was it 5%? No. Right? Keep your position size so that when those tail risks, when those black swan events happen, you're not dead. The most important lesson is how to survive consistently in the market, not how to extract maximum return in a particular year. Returns is always is a correlation of how much risk you take. And these things would have been given you great returns, but if you put your house on it, you're out of the market. So be careful. And these are all, these hedge funds and the people who invest in hedge funds, like these are all Wall Street people, Ivy League people, right? There are fund managers who manage millions of dollars. Right? There is a Canadian pension fund who had invested $400 million in Celsius. Right? So stupid mistakes are what I should say. Any degree or any sort of knowledge doesn't prevent people from making stupid mistakes. When it comes to greed, everything is, doesn't matter which school you went to or how many PhDs one has. When it comes to greed, people do make stupid mistakes. So anyway, so Three Arrow Capital might be heading towards insolvency because again, they're getting some margin calls and don't have any more collateral to place. I know Gemini, was it not Gemini, which was the other fund? They liquidated their assets. So a lot of these two have spooked the markets, and now market is wondering which is the next domino to fall. Right? A lot of VCs have raised a lot of funds. I know Andreessen Horowitz is huge in this, and see a lot of comments. MSTR, which is MicroStrategy, could that be the next one to head into this trouble? Because MicroStrategy made some decent money. MicroStrategy by selling calls on it, because that was my hedge trade for your against crypto, which worked out well. Yeah, so at some point of time this year it was $891. I think it was above $1,000. That was way back in 2020. Yeah, but has been between $800 to $1,000 for most of this year. Has been trading around 906, 400, 500. Now it's down to 167. So will this be the next domino to fall? Who knows? Though he claims, Michael Saylor claims he has enough Bitcoin to post a collateral and continue to post the collateral for the loans that he had taken to buy Bitcoins. But if the value continue to go down, I don't know where is. Briefly, it was down. It was down, lower than 20K, which people are saying is to 19. Oh, now it is down to 18. So a lot of flush out continues to happen. Right, still a lot of flush. It'll be interested to see after this weekend, which is the new fund was gone belly up. I've been hurt too, but I have my own opinion on some of these projects, and will position size accordingly. Who's got more crypto, MSTR or Tesla? Oh, MSTR. Tesla had very few. If you are comparing it with who owns more crypto, Bitcoin treasuries. So Tesla had 43,000 Bitcoins. MicroStrategy has almost 129,000 Bitcoins. So MicroStrategy has way more, at least 3 times more than what Tesla has. Is MSTR no longer a tech business intelligence company? Not since 2020. I mean, the whole the narrative to invest is in micro strategy is that it is a proxy for companies to get an exposure to Bitcoin. Their whole tech stuff is way less. I don't value MicroStrategy based on how its business analytics software is doing. Its valuation is 100% based on how Bitcoin is doing. And that's the reason why many of other companies, let's say some funds, some pension funds who can't get direct exposure to Bitcoin, were buying the bonds, the convertible bonds from Microsoft, not Microsoft, MicroStrategy, because they wanted to get an indirect exposure to MicroStrategy. Sam says, I don't understand Bitcoin as we see blockchain users in Ethereum, Solana. A topic for some different day. It will take us, we can talk about hours on this. There are some use cases, some understand. There are some which don't, depending on what camp you fall in. The uses could be all different. And this is a never ending discussion. There are passionate points on both sides of the spectrum, right? Who will be true? Who knows? I only know one thing, that anything around crypto you're investing in, it is not for your generation. It will need one generation to prove its value. And when we talked about it, I think in one of the meeting, someone asked me, what's my feeling that, how strongly do I feel that it could go to 300K, right? Bitcoin. I said, as strongly as I feel that it could go to 0K. Right? Still, it's a very nascent market. You'll have to wait for one generation to play it out if it has to work out. So if you are in here for next 2, 3, 5 years, don't be, right? So I always tell, if I'm in this, I'm not for me, I'm in for my kids. I'm not going to enjoy the benefits or eventual loss of this, but it could go to 0, it could go to 300K, equal probability in my perspective. So be careful on this. Okay. All right. So let's talk about the state of cloud. Let me sip some coconut water. And then we'll look into the report from Bessemer Venture Partners on the cloud softwares. Because today, given what's happening on the stock market, especially on the tech sector, doesn't matter what kind of a company you are, everything is being thrown out. Right? You're generating cash flow, no cash flow, nothing matters. If you got a tech name, if you have been tagged as a tech, no one wants to touch you, right? That doesn't mean that the overall sector itself is bad. I'm still bullish on the cloud sector, and let's read this. We're gonna go through this today together on the overall state of the cloud. Any other questions before we jump into the cloud? Because I think that probably will be the last topic for today. Some of the stuff we'll cover in the next section. Won't have more time. All right. Okay with cloud, or you want me to maybe talk about something else? Let me gauge what's the interest on understanding what's happening to the cloud business. Or I have a couple of earnings that I can look into. Cloud earnings, or look at a company news. No feedback? All right, then I'll go what I had thought. Let's go through cloud earnings. So who is Bessemer Venture Partners? If you haven't been, in from software industry, you may not have heard these names, but BVP, Bessemer Venture Partners, is one of a respected VC firm. These are like early stage VC firm, like Sequoia Capitals of the world. And they have been investing in a lot of cloud companies. Some of these names, familiar names: Twilio, Pinterest, Shopify, LinkedIn, Auth0, but this has been now bought over by Okta, Yelp, Twitch, Wix, PagerDuty, Toast, and many, many more, right? So on their website, you can go and look for all the list of the companies that BVP has invested in, right? So let's look at the cloud report. When we compare the economy in 2021 to 22, we see two drastically different pictures. 2021 was, for the record books, total public cloud companies market cap reached 2.7 trillion. Then, of course, a lot of our tech IPOs in 2021, global tech M&A of 1.4 trillion. 2022, things have changed. No surprises here. Inflation is increasing, interest is increasing, geopolitical uncertainty. NASDAQ Emerging Cloud Index slipped back to 2020 levels, dropping 40% in value. So from 2.7 trillion, now the market cap of the overall public cloud companies is 1.4 trillion. However, despite this drop, or what we have called the SaaS scare, I like that, SaaS scare, at Bessemer, the cohort of cloud companies still exhibits strong fundamentals. So if you are watching the business of the companies and not really what the stock price is doing, these companies are still, average growth rate is 41%, gross margin 70%, 45% efficiency score. So 40% average growth rate, right? We are talking about some of these companies which are like hundreds of billions of dollars or market cap. These companies growing at 40%. We're not talking about small caps or micro caps. So these numbers, just because the economics is so favorable to SaaS companies, so that's why they are able to put such a great gross margin and continue to grow. Right? So what is the true state of cloud? Right? Some of these cloud companies are down 60%. Overall, the whole sector is down 40%. So public stock performance never impacts how we as a VCs invest into early stage business, but I want to focus on public stock because that's what I invest in. I don't invest in VC. That's a completely different way of investing. We still believe that the cloud model is the most important paradigm shift since the invention of internet. I don't disagree. I mean, we started to see the benefits of cloud only last 10 years. So in this report, we're going to cover these highlights. Why the model is so promising, why the SaaS is actually improving as an industry, right? Why the on-ramp means moving over to cloud is becoming smoother and smoother, which factors are driving adoption, what geographies and industries still see low cloud penetration, means future, there is a lot of growth opportunities there. What is notable about the SaaS ecosystem across different regions, and why the valuations may not be the best way to measure startup success. Which generally, I don't pay much attention when I see somebody raised it as I do look at the number, but then discount it by a lot because private valuations don't mean much. You got a rich daddy like Tiger Global or SoftBank who are ready to throw money, it doesn't really make you worth that much. Right? So it's always be careful when you look at the headline numbers of, oh, this company raised so much money at $1 billion valuation. There are a lot of games that get played into this VC between the, those who were invested, early stage investors, and those who are coming out late stage investors. It will pay us to look at who the late stage investors are, why they're paying high prices. Are those sometimes I've seen cases where I haven't heard the name of those investors. Maybe they are ready to pay higher price because they want a seat on the table. They want to be seen as an as a force to reckon with in the VC industry. They want to be on the same table where the Sequoias and the BVPs are sitting. Okay. So if I'm some unknown fund from a New York who wants to break into Silicon Valley VC ecosystem, yeah, I'll pay 20% extra because I'm investing only $100 million. I'll pay 20% extra and get into the same company wherein the Sequoias are there. And then the incentive for the Sequoias or the early stage investor is, if someone investing a little higher valuation, they can just mark up and say our early investment has gone up higher, right? So there's a lot of games that are being played. So that is why I don't pay attention to, I don't pay blind attention to this company has raised at $50 billion valuation, right? If you really want to look behind the $50 billion, go and figure out who has invested and how much. Right? Someone might have invested $100 million, but paid through the nose, and they only got 12, let's say 5% stake. That doesn't mean the rest of the 95% has, suddenly gone up in value. But that's how the numbers work. So, I think now I agree. Valuations are not the best one. I stopped using valuation in my investing thesis a few years ago. So the power of the cloud model, why cloud is powerful. SaaS allows businesses to deliver software through internet, make it available everywhere, and with the product that's continuously improved. We were talking about it at the start of the session, how in my professional life, we are continuously seeing more and more customers wanting to move towards the SaaS-based solutions, right? From their on-prem based solutions, because it is expensive for the companies to maintain, to first of all deploy, maintain kind of resources, and then continuously improve upon it with patches and the new versions and all that stuff. When a SaaS business achieves best-in-class sales efficiencies and net NRR, net revenue retention, they can generate net new recurring revenue with unprecedented. Okay, too much of a big words. Let's skip that. All they are saying is, once you are efficient in your sales cycle, then you actually don't have to continuously spend more to sell more of the goods, right? You have the same customers buying more and more services. So hence you increase what's something called as NRR, which is a net retention ratios, right? So there are some metrics that I track for my own company in terms of how are we doing on some of these SaaS metrics. Maybe I don't think it talks about SaaS metrics here, but there are a few metrics which are applicable to SaaS. So if you're interested in SaaS companies, want to keep an eye on those metrics. Maybe sometimes some next session we can talk about that. So let's go back to basics of the cloud model. What is talk about? $1.2 of ARR, 15 times ARR is a multiplier, $18 for enterprise value. Best in how are they coming back up? So $1 of sales and marketing expense. They talk continuing on the sales efficiency ratio. You spend $1 on sales and marketing, your recurring gross revenue pay back your S&M in 12 months. So your this is called CAC, cost of customer acquisition. Another metric, it's around 12 months. Okay. Best in class cloud companies can turn $1 of investment into $18 of enterprise value in 12 months, given 15 times is the multiples of ARR. See, multiples have changed. From being 30, 40. In fact, I don't know if it changed everywhere. Depends on sector to sector. Last week, I know of another company and we were talking about its new valuation. They raised the money at 30 times the ARR. So I think there is still some fraud because some companies are still raising money at 30 times the ARR. Yeah, 15 seems to be more reasonable though. Right. I think the net, the power of the cloud model is the internal rate of return that you can generate by how much dollars you're putting into the business. So Looking at I'll just go through the highlights. Looking at the conservative assumptions, the average company could generate 68% IRR for every dollar that they pour into sales and marketing. Right? In comparison, S&P companies get around 20% on IRR. So that's where just from the business model perspective, because your recovery is much faster, you're able to deliver the products faster to the consumer at a lower cost to the consumer and lower cost to yourself as a company. From a return on investment perspective, this model works. Or just how powerful this model is. So these are the gross profit returns on many companies, right? On S&M spend. So DigitalOcean is what, 175%, huge, right? Top performing cloud companies saw well north of 100% IRR. So if you invested 1% in getting the revenue in your sales and marketing, you are able to get $2 out of that investment, right? So even though we're not talking about the stock price here, we're talking about the revenue and the cost. We right now just focus on the business of the companies, right? Some of these stocks have come crashing down. That's different. But from a business perspective, is much profitable business, right? Companies like DigitalOcean, which is I would say AWS for small and medium businesses, Datadog is analytics, Zoom, I don't have to talk about Zoom, everyone knows about it. Atlassian is a collaborative companies for building software. Shopify is helping merchants to those who don't want to get logged into Amazon. They still returned over 100% IRR. So they put $1 in increasing the revenue, and they're able to get the $2 in the revenue, not with the same other S&P 500 companies. Right? The model and the products are getting better and better. So every day tech improves with more bandwidth, more data, more APIs, more advancements, powering everything from image recognition to language generation. I don't think anyone can dispute that. We are creating more and more powerful chips. Apple just released M2, which is more powerful than previous ones. All the semiconductor chip companies are focused on creating, smaller chips where we can pack in more and more transistors, more and more computation power. Right? So, which will allow companies to do more data crunching, more calculations with lower and lower cost. Right. So historically, the first act was software as a service, and with time, pioneering SaaS companies are layered on embedded fintech solutions. First, you start with the basic product service, then you start adding the other stuff, right? Second act broadens the business addressable market. Right? We talked about company Mercado Libre, Meli, been pretty bullish on it. Started as an e-commerce company. Now, one of the most growing business division of their company is their payments, right? Mercado Pago. Shopify, now the similar things they're talking about. Shopify, they launched payments in 2015, grew their annual recurring revenue from 50 million to 150 million in a year and a half. Right? So what suddenly happened with this? Right? Now your addressable market becomes much bigger. So the TAM becomes much bigger. The area in which you can play becomes much bigger. And it is easy for a SaaS companies to keep on adding, services. New chapter in the cloud playbook, SaaS products and business models are even becoming better. You got a payments, you got card issuing, payroll. Look at there's another company that started with Upstart, right? I'm not talking about from a, whether because they use AI, whether if the AI will work, then it will work. But the way they have started to increase their services, right? Started with a student loan over, and then started increasing, and now they also acquired a company, Galileo, to move into banking as a service. Now they're providing auto loans, so they are expanding their services as well. So, but I'm not bullish on that as a company though, because AI needs time to prove itself. I want to give them some time to prove themselves. But you start with your core, and then you start increasing and sell a lot of other services. Today, companies are embedding much broader suite of services, including card issuing. Marqeta helps companies doing that. Banking, we talked about Galileo, group purchasing, insurance, logistics, usage-based pricing, so on and so forth. Right? So first prediction. So in this report, they also have 5 predictions. The first one, leaning into indirect monetization from day one is becoming table stakes for SaaS businesses. Right? Indirect monetization is now becoming their first act. So what do they mean by indirect monetization? Let's see, maybe they'll talk about it here. So let's see what they say. And okay, this is, okay, now I get it. So this is around, you start with your basic product and then you move into the other areas. Let's say your bill.com. Right? That company started with helping other companies manage their corporate bills. Then they started moving into payrolls, right? They could move into payments. The reason it becomes easier to move into all these side businesses is because there are many companies which is making it much easier. So you want to create your own card, Marqeta helps you to do that. You want to integrate payments, and Stripe helps you to do that, right? So thanks to proliferation of APIs, which is called application programming interface, it is easier than ever to build products that monetize indirectly on a range of ancillary services. Right? I could offer all these because it doesn't cost me hand and leg to create a service out of it. So in some rare cases, companies are even jumping to completely free software as a lead generation tactic to capture more of an indirect monetization streams. So sometimes you got to be careful where the company is actually making money from. They may be making money from selling ancillary than the core product, possible. But like I said, this is a rare cases, right? Businesses that we have seen successfully lean into these indirect monetizations are some of these businesses that they talked about. So one is indirect monetization. A lot of companies are moving into that. Evolving cloud adoption on-ramp. In addition to the advancements in APIs, the on-ramp to the cloud is becoming easier. How you get your businesses from your traditional model onto cloud becomes much and much bigger, because the offering on the cloud is also becoming much bigger, is becoming much better. So early adopters means they will just go everything with cloud. And this is what many of the startup companies who we call as in the forefront of technology will develop everything on the cloud. Don't want to keep anything that I have to manage myself. Right? Early plus late majority will have some security concerns. And there are industries which will never move 100% to cloud. So they will deploy something either on the hybrid cloud, means some of the things that they control, some of the things that they leave everything to the cloud provider to control. Or some of the data that they will keep on the data center, some of them will move to cloud. And the lastly will be the ones which are sitting on a cloud and then moving the data to on-prem, some of the customers that we are working with. Right? So the advent of, VPC, the virtual private cloud providers, etc., making it easier for companies to start moving the data onto cloud. Right? On-prem is becoming better. So prediction 2 is a cloud will go to marketplace. So cloud marketplace has emerged as one of the most natural places for sellers and buyers to transact. What I mean by this is, for example, if you go to AWS, for the, want to run your software on AWS, you don't want to invest in your own hardware. That's just one thing. There is a marketplace on AWS where you can go and buy another software. Oh, I want to do some data analytics, right? You might be, and I don't know exactly where Datadog is available or not, but I'm sure there are other, let's say Tableau, right? Tableau may be available on AWS, or some other analytics software may be available on AWS. So the cloud is not that you have just deployed your own stuff. You can buy other companies' softwares onto the cloud. So the cloud, that's why the cloud has become a marketplace. So there are marketplaces which are like Red Hat Marketplace. This is what IBM says, came through IBM acquisition. You have a Google Cloud Marketplace. You have an Amazon Marketplace. Basically, all the big, 3 big cloud providers have their own marketplace. And, in my previous company, we had our product available on both Microsoft Azure as well as AWS Marketplace. Right? And we were also able to install it on-prem for our customers. So the marketplace, you can, more and more software are also moving towards marketplace. Right? The cloud is selling the cloud. What does they mean by that? Sorry, let's continue the marketplace. They're still nascent, but we saw marketplace transaction grew 70% to 4 billion, which is very fast. Now, again, as more and more companies are moving towards cloud, now they are trying to integrate more and more softwares on their cloud offering. So it becomes more and more stickier. Now, if you want to move off the cloud, not only you have to, ditch AWS, but also you have to ditch in all the other products that you bought on that marketplace and add it onto your offering, right? Next, the cloud is selling the cloud means going forward, we predict that a marketplace procurement will go fully mainstream and become a standard component of a go-to-market playbook. So frankly, I had no idea about this. That's why I think it helps for us to see what VCs are seeing in the market. Right? Amazon's cloud, they are competing, Microsoft Azure, they are competing for Amazon, for companies to move their software over there, over to their service, to their services. But the next step is around the marketplace. The marketplace is nothing but like your app store in the cloud. Which company will win? Maybe the next decade, it looks like that's what BVP says, is in future, it will be determined by who has got the best marketplace. Which phone do I want to buy is dependent on what apps are available in those app stores. That may happen in cloud as well. Enterprise spend on IT continue to climb. So now, because IT is a great enabler for businesses, and the spend on IT will continue to go higher. And from a cloud perspective, I think more and more, my reading, more and more budget will move towards cloud, because it helps to reduce the cost of running your IT operations. Right? So other macro drivers, cloud is becoming more efficient. Software has become integral way the business happens. Just last month, the US quit rate was 2.9%, while the unemployment rate dropped to the lowest. Not this week, but again, in the US, the unemployment rate is still at one of the lowest levels. So how do you do more? with less people is basically you offload all your work to these cloud providers. So essentially the tailwind for the macro tailwind will continue to be in favor of cloud providers, right? So there are three obvious opportunities. What they see is global supply chain in peril, yet 50% of US importers still use spreadsheets to manage their businesses. The environment is ripe for adoption of SaaS products to help manage the global supply chain and increase efficiency. Great. Next, we need to figure out which are the softwares which help companies to manage supply chain in cloud. Number two is labor market as competitive as ever. Once thought to be temporary okay. Remote and hybrid work is here to stay, and cloud software is in critical ingredient for this new workplace. I know Elon Musk has told if you want to stay at home, you can quit, but I think hybrid is going to be the way of life. You're not going to go 100%. Do I like to go to office? Yes, I do go to office, 3 times a week. But another 2 days, I'll stay and enjoy, work from home, because I don't have to spend time, because I can't find those times in the morning or because of back-to-back meetings. So the hybrid is going to continue to stay here. So if the hybrid is going to be here, some of those cloud services will be needed. And finally, on the individual levels, 1.1 billion freelancers. As a freelancer, you don't have much money. If you want to bootstrap your business, it's much easier to bootstrap by staying on the cloud. So that's the prediction 3 is cloud software will help close this whole productivity gap. Right. I'll skip this. So a lot of companies which are building cloud solutions to close the, one of the biggest drawback I hear around the hybrid workplace is if you are remote, the productivity goes down. But there are many these companies who are working to make your hybrid work more and more collaborative and not lose on productivity. Right? Yesterday, because I generally go to office on Fridays. So yesterday, one of our engineering head was there and we were talking about it. And I was surprised to see his response was that his team is less productive while in office. He says, I'm like, we're in office. He said, I just come and, meet you guys, but we get a lot more work done when his team is actually not in office, which was an eye-opener for me. I thought, I'm hearing different things and again, one is not a sample size that you should rely on, but that was a different comment I heard from the people who are on the forefront of delivering, right? They say, on our office, we are not that productive. So next one, cloud penetration is still low, right? For example, on SaaS is only 6% of US restaurant. Public transportation, Optibus has reached just 1% of total public transportation software market. Right? Software for services, home services is just 1% of overall time. So net, the penetration is still very less. The market is much bigger. And so far, we have only, the SaaS model has penetrated only, fraction, very small amount of the overall market. And the public cloud spend is just 10% of the overall IT spend. And the overall IT spend will continue to grow. And the proportion of SaaS as a total of the IT spend will also continue to grow. So this is equivalent of your, in business, if you talk about operating leverage, that for a SaaS companies, not just the SaaS, the piece of the pie for SaaS is growing as an overall IT spend. The IT spend itself is growing. Right? So both, points to a better future for SaaS companies in next 5-10 years. Right? So 10% is overall spend in SaaS. Overall IT spend was 4 trillion. And this is from a region perspective. 55% of global public cloud spending is on North America side. Other regions, lot more growth. So which brings us to next one is cloud will go local to go global. I don't think this should be a news to anyone. We talked about it. All the governments across the world have become more and more careful and have become more demanding in terms of keep my data in my physical locations. So major cloud players are now born across the globe. Cloud companies is not only happening on US. We are seeing a lot of companies coming outside of US. Atlassian, Canva, two big ones coming from Australia. On China, Agora, which is on the AI side. I don't know Yuuzhan. I haven't used that. Kingsoft is a competitor to Alibaba Cloud. And then Monday.com, Zoho, and Freshworks are from India, and then a couple of them from European region. Right? Innovation happening across the world. And then we got a SaaS businesses, which will be again focused around local SaaS providers in different regions. So we got a China SaaS, over 300 unicorn, and half of the world's most valuable internet companies. Who would have thought, let's say 10 years ago, that China will become such a big force in SaaS and on the tech space, right? So China SaaS ecosystem, they got 42 plus SaaS companies, 45% cloud spend growth, which is the highest in the world. I think Azure grew 40%. Within the US companies, Azure was the one with a 40%, which was the highest. I think then was Amazon, 38 or something. So, and the number of public and private cloud companies in China with $15 million greater ARR is accelerating. But ARR is annual recurring revenue. So a lot of SaaS companies in China continue to grow in China. And that means also some of the cloud providers in China, like Alibaba Cloud, like Kingsoft, they got a lot of tailwinds because of the demand for their services from SaaS companies in China. Right? I haven't used any of them, so I don't have much information around these some of these innovative companies in China. Right? Europe side. So Europe, we saw some of these companies. GitLab is from Europe. I didn't know that. Good to know. UiPath, I knew. So these are some of those big companies have gone IPO in recent times, and a lot of people talk about it even in US media. The SaaS companies have increased 400% year-over-year increase. That's amazing. Right? And this is their ecosystem. Overall revenue between 2020 and 2021 up almost 400%. So let's go to the next one, which is India. Projected to be valued at $50 billion, India SaaS has reached a critical inflection point as venture dollars deployed in a region. So this is what I was talking about. I see a lot of US-based venture firms deploying a lot of capital in India SaaS companies. So a lot of, again, the reasons are pretty clear. digital rails. There are a lot of, even some of the payment systems in India are more advanced than what we see in US in terms of online payment. Right? You can pay through a bar, just a QR code. I don't see that happen in US yet. Proliferation of smartphones. More people have smartphones than it's a statistics that no one should be proud of, but there are more people who have smartphones than toilets in their house. Right? More households have a smartphone than toilets. Of course, digitization continues to be a force. And we saw a lot of companies in India went IPO, which surprised a lot of traditional investors because the valuations were mind-boggling. They don't make any profit, just like US SaaS companies or tech companies don't make any profit. But things we have started to see, that ecosystem now growing in India slowly. So again, a lot of oh, there's a name for Perfius. Okay, I worked with them in my previous life. So again, so the net is SaaS is not just limited to US. Across the world, we are seeing growth in the SaaS companies and the SaaS services providers both. Right? Amazon is investing heavily in India. So there are two ways in which companies have invested in India. One were to have their back-end office operations, but now I'm seeing a lot of companies are investing in India because they want to capture Indian market. Still, the regulations are not in favor of 100% foreign investment. So many of these companies have to tie up with some other company in India to penetrate the market. So the market is not still open completely open for business in some sectors. But there are many companies that have been eyeing. That's why Walmart, they bought Flipkart for $16 billion. And then there are Facebook invested in a couple of companies, I think in Reliance, and then another companies, some $5 billion, because they all want exposure to Indian, the growth in e-commerce or general, move towards the digitization in India. So they're going as a partnerships in India. But yeah, some of these companies are growing like crazy. And third one, another ecosystem where we see a lot of companies coming, SaaS companies coming in, is Israel, right? They got a tremendous scientific pool in Israel, and we see a lot of great companies coming from Israel as well. There's one more, I think there are a couple of shares I think I hold from Israel. One is Nanox, that is Israel. There is a cloud, can't recall the name. There is another company which is from Israel, which I hold in my portfolio. And last year, 2020 and 2021, there are many companies that went IPO, were all, many of them were Israel-based companies. So we do see a lot of growth in Israel as well. Sridhar says, heard many are slowly withdrawing investment in India due to inflation. So this is what happens. It's not just to India. If you really look at whenever there is a fear, the FIIs, that's the term what's called for in India, is foreign institutional investors. FIIs will just move the money away from emerging markets or back to US. They'll deploy capital back to US because now interest rates in US have increased. You can get some yield from US. Why do you want to go and take a risk on emerging markets? Right? Emerging markets by definition are emerging. There's a great opportunity, but there's a risk. It's also a riskier one. And not the first time. Every time when we see dollar becoming stronger, it is not a good thing for emerging markets. Now, if you look at the TXY, US dollar index, look at the dollar. Dollar becoming stronger, a lot of the investment will try to flow back into US. When dollars start to become weak, the environment is good. You see the money, these big institutional investors, foreign institutional investors going back and investing in a lot of developing countries. So that's what is happening. And it is nothing new. It happens every time. FIs will take money out because now they can deploy back in US and get what's the treasury fund, maybe 1.5, 1.75. So they'll deploy the capital back. Yeah, Redis was one. So again, I think I'm still bullish from on the SaaS side. The next to talk about why ARR is a new valuation. Thank you. Finally, VCs firm to open their eyes to look at revenue. A little late, but it's better late than never, is looking at the numbers of ARR in terms of focusing on your annual recurring revenue, or not just, hey, what was the last valuation? What was the last valuation on which you raised your last funding round? Okay. Again, being a unicorn is overhyped. This is true. More than 1,000% unicorn exists. So that you're not really a unicorn. I mean, the whole definition of unicorn is flawed. It's based on someone took a very small stake, but valued at more than $1 billion. That doesn't mean, like I said earlier, if someone taking 5% stake, doesn't mean the rest of 95% suddenly becomes, should be valued at the same valuation, right? So better metrics is to focus on ARR, annual recurring revenue, and do a multiples based on that. And maybe we'll look at one chart from Jamin Ball to see what's a current ARR in the markets on the public companies, to see, and how they have dropped over for last 1 year. So prediction 5, 2020 will be year of Centaur. Centaur means you are having 100 million in ARR. So by the way, a few years ago, this used to be the case that you need to have $100 million of ARR before you even think of IPO. And I recall it because one of our previous company, before we went IPO, we were very focused on, let's just get our revenue to $100 million before we hit IPO. Gosh, I think we should have waited for 10, 12 years, because in 2020, you could go IPO with $0 revenue, or even you have a revenue, that's an anomaly that you're going IPO with revenue. But 100 million ARR used to be a kind of a table stakes when you're trying to, as a software company, you're trying to go an IPO. But now I'm talking about more than 10 years ago. Markets have changed because there were a lot of free capital. Maybe we will go back to the same position wherein if you're going IPO, you better have some decent amount of revenue. Would love to see that. But BVP predicts that we are moving from unicorn to centaurs, means just rather than always talking about this is a new company, it's a unicorn, maybe we will talk more about this company is centaur, they have more than 100 million ARR. Okay. That's the next prediction. Unicorn require magical thinking. Centaurs do not. Yes, because unicorns you necessarily don't have to have any revenue. Your valuation is based on what the last VC thought you are worth. And time and again, we have seen VCs just going overboard. SoftBank lost 40%. Tiger Global is down 57%. So VCs can, they also commit a lot of mistakes. Don't have to. But this ARR number, it doesn't need any magical thinking, right? A company who's having 25 million ARR and a company having 100 million ARR, we know who's bringing more revenue. So no magical thinking, pretty clear when you're comparing based on ARRs, right? So you'll have a tangible growth in businesses, right? Versus reaching valuation based on magical thinking. So that's the next prediction. Center offers a more accurate pulse on overall cloud health. Sure. So if overall ARRs are growing, or there are more centaurs coming in from SaaS, it means they are able to gather more and more revenue. They're able to grow revenue more and more, means more and more spend happening on SaaS. So hence, to know the health of SaaS market, maybe focus on how many centaurs are there, not how many unicorns are there. I kind of agree. So Bessemer's $1 million to $100 million ARR chart. Okay, so they're talking about how some of their companies moved from $1 million to 100 million, and how many years did it take? The companies like HashiCorp and LinkedIn, less than 4 years to move from $1 million to 100 million. This is great. So anyway, I think that's it all on the SaaS side. Sorry, I mentioned because we talked about valuations, let's look at public valuations. There we go. This chart comes out, table comes out every week. So right now on the public side, next 12, EV to the next 12 months of revenue, the median is 5.5x. The bigger the companies that are growing faster are still able to command about 15x, but overall median of all the SaaS companies is 5.5x. Right? Does it have a chart? Because it's come way, oh geez, yeah, here's right. This is a 5.5x of, and last month it was around 20. So the valuations, if I consider, all software companies, all SaaS companies, that has corrected by 1/4. Now we are valuing the SaaS companies as a full cohort at the same level where we were valuing it at like 2016, 17, 15. Right? At that point of a time, and this is why I'm still bullish on SaaS, at that point of a time, the overall story of SaaS itself wasn't very clear. This whole ancillary things haven't even started. Twilio wasn't a big name till then. These are all small companies. And if you look at the top 5 medians, let's say top 5 from a SaaS perspective, how their overall median has gone down. Some part of time it was 80x, which is ridiculous, now to 14. So I think my perspective, overall SaaS companies are maybe overcorrected. Could we continue to see some weakness if inflation continues to go high and Fed tighten the belts? Maybe, but I think that there are opportunities. Let me put it there. There are opportunities that I will start to now, capitalize on SaaS companies. Right? With full acknowledgement, there may be another 15-20% drop down or drawdowns that might happen, but no one has been able to time the market. Neither will I be able to time them, nor will you be able to time the market. So you have to figure out when you want to be comfortable to increase or or want to get into the market. So SaaS looks to be in a decent position. So if you look at 5.5, yeah, that's where it was, like over here, way back to March 2016. Now, we could argue maybe March 2016 itself was overvalued. Possible. I mean, because we had free money and all that stuff. Is it possible? Yeah. But the businesses have also significantly improved. The TAMs have significantly improved. The cost of operations have decreased a lot. So all that should factor in for a better valuation of SaaS companies, which market is right now, they're not according it. So I am now becoming bullish on the SaaS side. Cool. So I think that's all for today. Going through, I mean, I learned a lot in the cloud SaaS, makes me a little more bullish on SaaS. And, some of the companies may still be highly valued. So got to be a little careful in terms of which I want to pick. Or maybe just pick up, there are some ETFs which are based on a cloud or SaaS. Just look into, if you're interested in this, maybe pick ETF. Don't have to do the individual company analysis. Steve says Disney failed in India because it underbid for the right to broadcast the game. Oh yeah. So I'm not sure which game you're referring to, but Disney. I mean, ESPN. The reason I have a Disney bundle is to get access to ENPS Plus. Because they telecast some cricket matches. I mean, India has its own league, Indian Premier League, and I love watching those short duration. I only get to watch highlights, at 15 minutes highlight during the lunchtime, and I had to buy Disney bundle because ESPN does that. So Sridhar says many bigger companies, in my opinion, trying to figure out how to sell SaaS products. Sales commissions are bigger for on-prem. That will change eventually, I guess. Many companies have realized, Sridhar, if you don't move to SaaS, you're dead. Look at SAP. SAP used to be the most valuable one of the most valuable software companies in the world. We did where's the Finviz? Where is SAP? Hold on, maybe let's go to SAP separately. Where is it now? They took too long to pivot to SaaS. I mean, you can't just rest on your past laurels. 120 billion only. Let's say there are software application. Overall, it is 120 billion, which is from a, oops, where did we go? Yeah, which is come way down over years. But so what they are doing, SAP started to pivot. Otherwise, it's game over for some of these companies. So this is 1 year, let's say 3 years, haven't done anything. So same is the case with Splunk. Used to be leader in your log analysis or data observability. Datadog came and ate Splunk lunch. Haven't done anything for last 3 years. Now Splunk is pivoting towards cloud offering. The kings of the Hadoop ecosystems, Cloudera, gone private, didn't do much because they took too long a time to pivot towards cloud. shares were moved from a $40 billion valuation to less than $5 billion valuation. So companies are having tough time, especially around the software side. If you're not born in cloud or if you're not pivoting to cloud, it's becoming very tough. For the companies who are buying a software, for them, buying a SaaS is much better than buying a licensed software, the way accounting works. So it's a win-win for both. If you're buying a SaaS and paying your recurring, annual fee, that gets into your OpEx and not CapEx. So, that's kind of also bump up my free cash flows. And otherwise, if you buy servers, all those will become go under your CapEx. So the mechanics for the buyer is better when it comes to SaaS. So the companies have to eventually have a SaaS offering. So how they're gonna motivate their sales team, I'll leave up to them to figure out the ways to motivate. The best will be to rip and replace. Change the whole sales model, and it's not the first time. Many companies I've seen that have gone through these transitions. Look at Splunk; they replace their whole C-suite because if your you're changing a complete business model of how your company gonna on revenue, maybe need a different thinker. You cannot band-aid the old players, the players who have survived on a licensing model, to now suddenly start thinking into SaaS terms. John asking a question: do you have this column or know the setting to turn on this in your TOS Analyze tab? Theoretical. Is it theoretical netlink? No, maybe I'll check on it, John. I haven't. I don't have that in here. Maybe I'll have to find out. Does it allow you to change it? Let's go to QQQ. It's under ply slices. Can I pick up columns under ply slices? I never looked at. No. Okay, maybe I'll have to find it out. Or someone might have customized it. I mean, Thinkorswim is pretty customizable. So maybe, and someone could have customized to get this here. Is this a theoretical netlink, or is this because there are some companies which I'm aware of who does a lot of customization on Thinkorswim, which is TheoTrade. I don't know if this is coming from that company, wherever you got the screenshot. So what's the ask here? This is the theoretical netlink or the TheoTrades? So with TheoTrades, then you'll have to go and check with the TheoTrade on how they got it.
I think it's theoretical. And okay, that's the screenshot from Dan Shergan, if you know who he is, Dan Shergan.
Yes. Okay.
And I just asked him, and he didn't know how he got that. He did not. Maybe it's a portfolio margin account. Nobody knows.
I have portfolio margin account.
And it doesn't show. Okay.
Maybe
I've never seen a way to customize slices.
I've not ever customized. Maybe it'll be a good question to call up Thinkorswim and.
Yeah, I will do that.
Yeah. No, thank you. I'll also figure it. Check how to do this. Link to the report. The report is available on the website, Sridhar, but you'll have to sign up for it. The reason I don't share the report is it used to be open, And then I saw people say, yeah, I'll just read the report and don't want to join the meeting. I'm like, no, we want you to participate here. So I'm like, okay, you know what? You want a report, I'll put it behind so people continue to join it. So it is on the website. Yeah, obviously. My intent is not to have people go and sign up on the website. I want you to come here, but just that I want to make sure people join here and we go through and have these discussions and not just throw the report out. But it's on the website optiongate.com. So I do put the recording and the document onto the website. Okay, it's called weekly webinars. That's where you will see the recording and the document. Cool. All right. Anything else we want to talk about? Another 5 minutes? Now, Sridhar, it'll take me maybe around a week, and both the recording and the document will be up. Any other question? Monday is holiday on the stock market, so don't go and trade. Enjoy the life. Go out for a walk. If your office is closed, if your office is working, of course, then right now the best bet is stay with hold your job. Other markets are not performing. That's probably bringing food, putting food on the table, keeping lights on, paying the mortgage. So continue to focus on jobs, and will give us a survival power to stay in the market. Delivery bus. Okay. So Sridhar says, any thoughts on supply chain issues? So I think it was yesterday, while driving back, I was listening, and I don't even know who I was listening to, but looks like some of the supply chain issues may be getting closer to, not closer to resolution, but the fact that the price of shipping containers from China to US, those prices are now coming down. Let's check it out. I just heard shipping container prices from China. At some point, it used to be 6,000, became 20,000. How old is this data? Oh, I want to. No, I need the chart. So what I heard was some of these rates have started to come down. Like in October, those hit crazy prices. So those are now started to come down slowly. Number two, as we have seen, many of the retailers are, they got more inventory than what they need. Now, there are two issues. Number one, the inventories are now becoming, the lanes are now opening. So I think from a supply chain perspective, we are moving in the right direction. Will everything be normally next 1 month? I don't think so. And that is largely dependent on what's happening in China. A week, you see the lockdowns are being lifted in China, everything is great. And the next week you hear the news, oh, no, there is another COVID flare and China is shutting down. And the whole supply chain moves into a different direction. So just one second. So that's what, and I am hopeful that, there we go. Thank you. Shipping rates graph. Okay, yeah. So Yeah, so I wasn't wrong. So it is actually coming down. So whatever I was hearing about it was probably okay. So I should bookmark this. Thank you for sharing this. So that means we should see some respite in inflation. The portion that is because of the supply chain issues. There are other reasons for inflation also. But from a supply chain perspective, looks like this is becoming better. M's question, how much percentage are you holding in long-term investment? Everything I do is for long-term. Now, I have short-term trades so that I can stay invested for long-term. Right? So, but that doesn't mean that my focus has moved away from being long-term. So, for example, like I showed those hedge trades, like selling calls on QQQs, etc. I'm doing that so that I can still hold my Amazon shares. I can still hold my Google shares for long term. I don't think I would do any trade just to make, hey, I would just want to make money in this week. So from that perspective, everything which I'm focused on is for long term. I use steps that might look like a short-term steps because those trades are for a month, but those are helping me towards my long-term goal. So I don't know, Em, if that answers your question. Now, within long-term, I might have some which are lottery tickets, right? Zero revenue companies, but if those perform, eventually work out good, yeah, could become 10x, right? Multi-baggers. Some companies are large cap companies, pretty stable companies, right? Berkshire Hathaway, Amazon. I'm not sure if I'm from a business perspective, right? Microsoft. And then I have some precious metal. I have some of the other up and coming companies like Pinterest, Shopify, Mercado Libres. So I have a pretty, I think I hold pretty much from the company's perspective, I have stocks in of all the sizes of companies. So when the stocks such as Shop are down more than 50%, you don't exit, but still holding. So Shop probably may not be the best method because I got into Shop, first position was around 180 few years ago. Second position I entered was in March 2020 when it was available around 350. And the third position I opened is in the very like last 2-3 weeks. I started building position again when it was below 400, right? So for me, the Shop hasn't gone down 50% because I never opened positions. But the right criteria, maybe another stock which would fit your question is Mercado Libre, right? That's a stock which I had bought even when it was $1,900. I bought that stock when it was $300. Right now, I think it's around $700. So when will I exit it? If I see that in a quarterly report or an annual report of Mercado Libre, I find something which I don't like, frankly. In all the quarterly reports, and I will look back and I don't see any long-term issues as such. So I'm still holding, and that's where then I do my short-term call spreads to reduce the cost basis. Because I don't know if the market sentiment improves, Mercado could go back up 25%. I mean, 5% movement, 5-7% movement on the stock I see every week. Things like that. So other things like, so I don't sell if the stock price has gone down. I sell when I find out that the company, I don't like the direction where the company is taking, or or there are some issues, corporate ethics issues with the company, or the new CEO has come in and now he's trying to take some short-term measures, etc. Those are the reasons I will sell the company. I don't sell company based on that the stock price has gone down. I use other methods to stay in the stock, because I don't know when the stock price will come back up, because we don't know why it went down. So I'm still holding Mercado Libre. I mean, I've been through NEO from $2 all the way to $40, back to $20. But over years, if these businesses continue to do good and we continue to sell premium, my idea is to get to a zero cost basis. Let's see how long does it take. I do have some stocks which are zero cost basis. So as long as business is doing good, I will continue to hold my stocks. Other reasons, which is other people might have, is I need money, right? Yeah, I need to spend something and I need to generate cash. That could be another reason when you may want to sell your stocks. Right? So for that, I have I keep cash on the side. But if required, that could be a reason when I will sell. Third reason in which I've sold some stocks is to take tax loss harvesting. I got out of my Netflix just because I wanted to do some tax loss harvesting. I did on Zoom as well, because my unrealized loss on Zoom was big enough and I wanted to just reduce my taxable gains on the others. So I sold off Zoom. And after 30 days, now I'm back in, I got back in Zoom selling put spreads. So those are some cases where I look at tactically why I want to sell stock. Yeah, just different investment strategy. That's just a different type of person I am. Yeah, there's nothing right or wrong. Like, investment is very personal. So anyone doing any another way is also right, because it suits their behavior and this suits my behavior. All right, cool. All right, I think that's it for today. I don't know what someone was trying to reach out, so I'll get back to those people. And thank you, everyone. We got a long weekend in the markets. So yeah, we'll get to do something different on Monday this week. So thanks, everyone. And we'll talk again next week. All right.